Hi, welcome to GRASFI session 5B, Sustainability in the Time of Uncertainty. It's taking place on day 3 of the 2020 GRASFI virtual conference. I am Brooke Gouven of the Columbia Center on Sustainable Investment, and I'm absolutely thrilled to be moderating this very timely discussion. These uncertain times. This is a phrase that has become ubiquitous in characterizing the present. We are not only grappling with the adaptation to and mitigation of various multifaceted crises, such as climate change, that have been and continue to impact our world, and in particular, the ways in which individuals, firms, and governments react and respond to these persistent crises. But we're now also living through fundamental shifts caused by the unprecedented COVID-19 pandemic. The ways in which we understand, assess, analyze, and advance sustainability and sustainable development during and following this time is ripe for understanding and analysis. In particular for this conference, how do we view and understand finance and the firm in this context? This panel discussion hones in on the intersection of sustainability with two of the most pressing crises of our time, that of the COVID-19 pandemic, which is, of course, a crisis of nearly unprecedented proportion from an interrelated health and economic perspective, and the no less salient but persistent and longer-term crisis of climate change. The papers presented during this panel discussion will consider these two crises through a financial lens, analyzing the ways in which sustainability ratings react to crisis, the role of universal asset owners in internalizing crisis-based norms and feedback loops, and the cause and effect of firm-level decisions to adopt internal carbon pricing in their operations and business models. We'll start with COVID-19, and we'll first turn to Julia Meyer to discuss her paper with Ola Mahmoud, Sustainability in the Time of Uncertainty. For our second paper on COVID-19 related research, we'll turn to Ellen Quigley to discuss universal ownership theory and the double hermeneutic, norms and feedback loops in the age of COVID-19. Next, we'll move to two papers that will address climate change and the role of firms in controlling carbon emissions through adoption of internal carbon pricing practices. So for that section, it will be John Bird discussing capital budgeting and climate change. Does corporate internal carbon pricing reduce CO2 emissions, which he authored with Elizabeth Cooperman and Ken Hickman. And finally, Gianfranco Gianfrante will present his work with Nuno Bento on determinants of internal carbon prices. So please do type your questions into the Q&A and we can turn to them after the four presentations have concluded. So I will first turn to Julia Meyer to discuss sustainability in the time of uncertainty. If you could take the stage, Julia, thank you.
Okay, I'll just try to share my slides. And thanks a lot for the introduction, and thanks a lot for having me here and giving me the chance to present my recent work that I have written together with Ola Mahmoud. She's from University of Basel. And as you said, it's a very timely research question, a very timely analysis that we did in the recent stock market crash. So what we did actually sometime in mid-March, we looked at the stock markets, international stock markets. This example here is the US stock market, S&P 500. And we obviously saw stock markets crash, prices coming down, and not really surprisingly, of course, volatility indexes going up. This one here is the VIX. Showing a sharp increase around the same time, beginning to mid-March, when stock markets crashed. At the very same time, we actually observed that there was an increasing interest in sustainable investments. We saw that with many different blog entries, with social media comments by large index providers, by large asset managers, everyone stating that the interest of sustainability seems to increase during that time of increased market uncertainty. They observed large inflows in sustainable investment funds and also better performance of those assets. So we asked ourselves, is that really the case that sustainable assets seem to outperform during that crisis? And if so, why is that? So we had a look at some existing literature. Obviously, there was some literature already on the financial crisis. The very prominent one is by Linz and co-authors in Journal of Finance. And they actually observed during the financial crisis that actually good ESG performers had a better performance during the crisis. We also saw a few very recent papers already looking into the corona crisis and pointing to similar results. Then we asked ourselves, is it really the ESG performance, so the sustainable profile of the company that really drives this outperformance? Or could it be some other factors that were also found to be very much linked to sustainability, such as fundamentals like firm size, for example, or cash ratio, leverage, etc.? Or is it maybe only because those companies have a better risk profile overall, because recent studies also show that actually overall ESG performers have lower downside risks? So we had a more close look into the normal performance of the US stock market. We decided to focus on the S&P 1500 to cover large parts of the US stock market. And we took two different types of ESG ratings and combined those two, namely OWL rating and True Value Labs. We decided to take those two ratings because, as we understand, they have a very broad approach of ESG rating. They take into consideration market characteristics, but also, of course, firm fundamentals. And they also base their analysis on other existing sustainability ratings, such as MSCI. So we think that we capture a really broad sustainability picture with those two ratings. We also obviously took equity indices, equity performance indicators, firm fundamentals, and on top of that, we also consider implied volatilities based on option prices to consider how risky investors actually judge a certain investment. So what we found in the very beginning of our analysis was quite striking, namely that we also found that ESG performers, meaning here the best quintile of ESG performers, the blue line, had a lower downturn in returns during the time of the crash. And we found that by looking into raw returns, but also by looking into risk-adjusted, pharma-French-adjusted returns, the very same picture. And we saw that the lowest ESG performers and those who didn't even get an ESG rating, they had much lower abnormal returns during the time of the crisis. We ran a few initial regressions and actually found that this relation between abnormal returns and ESG ratings seems to really be significant over the whole time. And we also considered different control variables, firm fundamentals, etc. And the relationship was still very significant. Then we thought we need to do a different approach by looking into much more detail what actually those ESG ratings capture. So that's why we went back and took 3 years of monthly data and actually took the ESG ratings as the dependent variable and run a regression by including all those firm fundamentals that have been identified to be important for sustainability ratings, such as I mentioned it before, the size, but also measures of idiosyncratic volatility, return measures, cash ratio, leverage, etc. We took 3 years of data and sort of filtered those firm fundamentals out of the ESG ratings during that period. And what we kept in the end was actually the residual term that is not influenced by all those firm-specific indicators. And we then went one step further and looked into what actually remains in this residual term. And what we found is quite interesting, namely, we found that actually this residual term seems to capture, on the one hand, very significantly the uncertainty profile of a specific company. And I'll go into detail what we mean by uncertainty just in a minute. On top of that, we found that actually investor sentiment is also very much linked to the ESG rating of a specific company. So we then, in fact, argued that by having identified those two factors driving ESG ratings, namely uncertainty and sentiment, and by filtering also those two effects out of the rating, we in the end can really say that the residual term from our second regression then captures the idiosyncratic sustainability component that really reflects the sustainable profile of a specific company. Now, what do we mean by uncertainty? We take into account different measures for risk on the one hand, so the realized volatility, but also the implied volatility of a stock. And on top of that, we went one step further and also took into account uncertainty measures, namely ambiguity of those measures, not only taking into account the risk of a specific stock, but also taking into account whether that volatility changes over time or whether it's very constant volatility. Just to take into account that this is much more difficult for an investor to judge on the profile of a company if the volatility is not constant over time. So this is much more reflecting the uncertainty profile of the company. With regards to sentiment, we took measures that are very well known from behavioral finance, mostly linked to liquidity of stocks, such as bid-ask spreads and volumes, but also linked to the valuation of the stock. What we found is quite interesting that actually in the top graph, you see here that the uncertainty profile seems to be very much linked with the ESG rating, showing here in the red line. The red line shows here the bottom decile of ESG performers. So the lowest performing ESG companies have, over the whole 3 years that we look at, the highest uncertainty profile, and vice versa for the best ESG performers. When we look into investor sentiment, the picture looks a bit less clear. So the relation between ESG ratings and investor sentiment seems to change over time. And we are right now looking into much more detail how and when this relationship changes, whether it's linked to crashes or boom cycles, etc. So what we then did, we did again the regression of cumulative abnormal returns during the crash as a dependent variable. And as independent variables, we took here these 3 indicators that we found to actually drive ESG ratings, which is uncertainty, investor sentiment, and this idiosyncratic ESG component. And we look at the crash overall, which is the first column, and also at the very specific crash before the rebound started around March 18th. And what is very interesting, as we think, is that actually it's not only the very specific ESG profile of the company with the idiosyncratic ESG factor that drives the outperformance in the crisis, but it's much more so this uncertainty component that actually seems to be also part of the ESG rating. So the ESG rating of a company seems to very well reflect the uncertainty profile of a company. We do not find any significant effect for uncertainty and for ESG, idiosyncratic ESG, in the period of the rebound when companies actually start to recover. So our summary chart actually reflects this result very well by showing that actually over time of the crisis, the blue line shows the coefficient of the aggregate ESG score over time when we do a regression of the cumulative abnormal return on our driving factors identified. So ESG ratings are important, but if we do this decomposition of the rating into uncertainty and idiosyncratic ESG, we see that actually the effect is very largely driven by this uncertainty component that we have identified. And we think that this is an interesting finding by showing that it's, on the one hand, really the sustainability profile of the company that is important for resilience during crisis, but it's also very much important that ESG ratings reflect this uncertainty profile of a company. Okay, thank you very much. I think this was about my 10 minutes, and I'm looking forward to getting your comments and questions in the end of this session.
Thank you so much, Julia. Yeah, I see we have one question already, which we'll turn to the Q&A portion. We'll turn now to our second paper, and I'll invite Ellen quickly to please take the stage to discuss universal ownership theory and the double hermeneutic, norms and feedback loops in the age of COVID-19. So thanks to Ellen. Ellen, you're on mute.
Apologies, I just did the classic mic thing. Thanks very much, Brooke, and very excited to speak with you all today. Great to hear that previous paper as well. This is a very different one. I might start by defining universal ownership theory for those who aren't familiar, because it's very much the core of this paper. So universal ownership describes basically the situation for large institutional investors who are much more tied to the kind of performance of the system as a whole, so the real economy and the financial system, than they are, particularly tied to the performance of any given company, because they tend to own more or less a representative slice of the economy as a whole. So if that's the case, then they would worry about things like so-called externalities like climate change and inequality, because the costs of those two things, just as examples, will get picked up everywhere in their portfolio, even if it's a small number of companies that are disproportionately contributing to those problems in the first place. So I view universal ownership as kind of the paradigm for our current age, because we're dealing with quite a number of systemic risks. And this whole session today is about really two of those, but my paper also covers a few more. So the risks that, and I won't spend too much time on this, but we all know COVID has exposed a number of risks to us. So first of all, we've known that pandemics were almost an inevitability for quite a long time. I work for the Center for the Study of Existential Risk at the University of Cambridge, and my colleagues have been warning people about pandemics for quite a long time. There have been reports even as recently as last year saying, all we need to do is spend as little as 1.4 billion in order to prevent a pandemic from becoming preventing a localized outbreak from becoming a global pandemic. And unfortunately, we don't seem to be good at responding to warnings like that or acting accordingly. So that's the preventative bit right there. But in addition to that, COVID and other pandemics like it tend to be more likely the more humans kind of have incursions into the natural world. So taking over habitats that previously housed animals that then come into human spaces, come into more contact with humans, and vice versa, having kind of pushing humans out of spaces that they've normally been in and into forested areas and so on and so forth. A lot of our diseases are zoonotic diseases, which means they come from animals, and that's going to become worse and worse as we continue to harm global biodiversity and so on and so forth. So it's linked to all of these other things that we already know are big systemic problems. So we know we have these big issues that have been revealed. Some of them have to do with labor and inequality, even things like Black Lives Matter. A lot of forms of inequality have come out during this crisis, labor issues as well. And with that have come some emerging norms. So there's some ideas that are being discussed now that really weren't discussed before. Even things like universal basic income, ideas like defund the police. A lot of these sorts of discussions were just not a thing before. And I looked at some of the search trends, and now these are much more common conversations. You could call them emerging norms because they are starting to shape public discourse and public policy. But alongside that, we have truly unprecedented fiscal stimulus, and that's very. We're ending up in a situation in which we have much more of the percentage of discretionary spending now than we normally would in a spending cycle. So a lot of a normal government's budget, most of it will be on things that are not considered discretionary. So things like healthcare and education and so on and so forth. And there's kind of this little slice at the top that can be allocated to other things that aren't just kind of mandatory priorities. And if you think about it right now, the stimulus spending that we're experiencing now is kind of the equivalent of many years discretionary spending. And we've also kind of accidentally or almost automatically gone into the territory of what was formerly also considered to be a strange idea, which was MMT, modern money or modern monetary theory, which is just the idea that a country with its own currency can kind of the amount of debt that that a country can go into if they have their own currency is much higher than people tend to assume. And we've kind of gone over these bright lines that we thought indicated, too much debt, too much deficit spending this year, almost without blinking. And that gives us a huge opportunity that I quantify in the paper. So my question that I'm trying to ask and answer in this paper is, can universal ownership theory come into play because of this crisis? Because it's specifically around systemic risks and how to address them. Is there a way in which this whole crisis that we're in right now can contribute to the development of universal ownership as a norm among the professionals who work in large institutional investment entities, such as pension funds and so on and so forth? So I've looked at how norms tend to be, how they tend to emerge and how they tend to develop, and the feedback loops that are inherent in that, and found some interesting work that I found very useful in looking at the specific question of universal ownership. So there's a legal scholar, McAdam, whose work I go into, who says that norms tend to emerge when there is a consensus that something is good or bad within society. So I think we would agree probably that systemic risks are bad. We don't like COVID, we don't like climate change. I recognize there's some differences at various national levels. But if you were talking about global consensus, those things do seem to have somewhat of a consensus, at least. Then there's the probability of detection. Detection as to whether an actor is violating a norm. And a lot of these large institutional investors are, public pension funds or sovereign wealth funds with a high degree of transparency. Not all, of course, but there does seem to be a certain level of detection possible. And then there's the question of whether it is both, whether the consensus itself is known. So is it, it's one thing to have a consensus around climate change or COVID, but do people know that there is this consensus? And I think that's also probably broadly true. And I also then, I'm not going to get into too much detail here, but I looked at Marty and Gaughan's paper that goes through how norms can emerge and become self-fulfilling. So this is what the double hermeneutic means. It's a self-fulfilling theory, and we have a lot of examples of that in finance, down to, for example, the Black-Scholes theorem was inaccurate when it was first presented and then became accurate because it became widely known and accepted. So lots of things like that in the financial realm, which is, I think we could view as a kind of a social system. And Marty and Gaughan, when they look at all of these instances of theories becoming self-fulfilling or kind of triggering the double hermeneutic, they point to a few things, and I'm just going to go over a couple of them quickly here. One is experimentation, so trying new things and having them throw up different results. And then one of the other items here is powerful initial backers. Universal ownership theory is kind of interesting because it does have powerful initial backers in the form of, Hiro Mizuno, the former CIO of GPIF, the Norwegian Sovereign Wealth Fund, etc. But in terms of experimentations, I wanted to throw out a few for universal owners to try in the wake of COVID, and given that we're in this unprecedented situation in which we have so much fiscal spending. So first of all, I do go through why ESG is not equipped to handle this situation. So just as an example there, ESG is all about the risk to your portfolio of ESG issues, whereas universal ownership really makes you think about the risk that your portfolio is posing to these risks. So for climate change, for example, it's how is my portfolio contributing to climate risk, not how will it be affected financially by climate risk. And then you've got the kind of general issue with ESG is that it tends to concentrate in public equity, and when you're doing asset allocation, so positive or negative screens or things like that, it really matters that you attach that to the right asset classes. So for example, if you look at fossil fuels, 90% of new capital for fossil fuels comes from debt. So most of that is bank lending. A good chunk is also from bond issuance. But public equity is all secondary market. If you particularly buy a share or don't, doesn't really matter in terms of how much money that company has to work with. So you really need to worry about these things when you're thinking about this issue. So my 5 experiments have to do with supporting a risk mitigating fiscal stimulus on the part of governments. I think large institutional investors have a key role to play in things like that. Another is helping to creating a fund to allow for the protection of large swaths of the ocean and land, which actually would allow for the thriving of fisheries and a lot of other industries that rely on so-called ecosystem services that we could end up anyway, it kind of makes sense financially to do this as long as you have the coordination dealt with. Then I've got some stuff around intervening in public markets as an active owner, doing things like voting against directors instead of focusing on advisory shareholder resolutions, which evidence suggests is less effective. And then intervening with institutions like banks, since they do so much of the issuing of new capital. Insurance companies, stock exchanges, auditors, all these other entities in the market who all play a critical role in the allocation of new capital, but also active ownership functions. And then finally, and I keep referring to new capital, you really do want to look at whether or not you are kind of automatically financing certain activities that contribute to systemic risk by purchasing bond issues that of companies that don't seem to be worrying about them, that are causing externalities and the like. And again, that is really largely on the debt side, but also private equity and venture capital are important as well. So I think if you try these 5 experiments as an institutional investor, we'll have a better answer as to whether now is the time for a systemic risk addressing theory such as universal ownership to become self-fulfilling. So, can it meaningfully address the issues that these experiments raise? And if so, then can we start to kind of act accordingly and truly become universal owners and change our investment practices to do so? So that's it. Thank you very much.
Thank you very much, Ellen, for very, very interesting findings. Now we will turn to John Bird to discuss capital budgeting and climate change. Does corporate internal carbon pricing reduce CO2 emissions? So I'd invite you to take the stage. John?
Is this
Mute, but yes, we see you. You need to unmute yourself though, and then you'll be perfect.
Okay, great.
Perfect.
Thanks for having me. And my paper with Beth Cooperman and Kent Hickman is pretty mundane compared to what we've just seen. I'm going to try to get the slides up. Let me see if I can do that. What we're looking at here is a pretty simple study. We wanted to ask the question of whether companies that use an internal carbon price or tax themselves actually reduce their CO2 emissions compared to other companies that don't. And the idea here is that if a company uses an internal price on carbon, and if it has availability of low carbon emitting investments, so it can build a plant that is lower emitting than maybe the standard way, or it can buy equipment that emits less carbon than the original stuff. And if the investment cost differential, so the cost between the low emitting and the high emitting assets, are either low enough and or the carbon tax is high enough, then eventually we'll see carbon reductions if the company chooses to make an investment using that kind of a criteria. So that was the kind of layout of our study. And The issue is we don't really know for a particular sector whether low carbon emitting alternatives exist and what the cost and the carbon tax that the companies are using are going to be sufficient to overcome any price differential. So we're a little bit in a black box here, looking at something more like this. Does a company use an internal price on carbon? And are there carbon reductions? And if so, then there's a correlation. And if not, then internal carbon pricing doesn't have much of an effect. What we do to kind of test this is we collect a sample of all the firms that reported to the Carbon Disclosure Project for the time period 15 through 2018 for 4 continuous years. And there's about 1,300 of these companies. And 400 of them, or just over, report that they use an internal price on carbon sometime during that sample period. Now, it's a pretty diverse sample. As I say here on this slide, firms come from 45 countries and 43 sectors are represented. The largest sector are financial institutions, so over 10%. The sample has very few firms that actually reported of carbon that they use, and the few that did, the prices range from $5 per metric ton of CO2 equivalent to over 100. So huge variation, but again, very few companies reported that, which was kind of an issue for us because we had hoped to look at the effect of the actual price used to whether there was a reduction. So we really couldn't do that very well. I should note that during this time period, the social cost of carbon, at least by the US EPA, was about $40 a ton. So these reported prices ranged around that number. Now, the design of the project is we looked at the change in emissions intensity. So revenue intensity will be CO2 equivalents in tons divided by revenue, and employee intensity is the emissions divided by employees. The firms reported these. It's all self-reported data, and so we're looking at within firm changes, percent changes, and this turns out to be important. And I'll mention this in the caveats again. The CDP data is pretty messy, and I don't think that we could have compared intensity of firms because they're reporting in so many different ways. They have much different boundaries on how they calculate emissions and so on. And so using this within firm percent change in emissions got away from a lot of those potential problems. So we looked at the entire sample and there were absolutely no results. So we did t-tests and we did regressions and there was just nothing there to report. So we began to think about why not? And when we did this, we realized that for a carbon price to matter, you needed companies that, first of all, were making investments. So we needed companies that had pretty large capital expenditure or CapEx outlays. We also needed companies that had pretty high emissions. The other thing that we needed, and this comes from the literature on cap and trade and whatnot, is we needed some variability in the carbon intensity across industries. So we needed there to be the opportunity or the availability of low carbon emitting investment alternatives. Now, one of the ways to look at this is this idea of carbon intensity variability, because if we have that, we know we have a best performer or best practices that other companies could move toward. And there was recently a report by Resources for the Future that showed this, and I can give the reference if people are interested. They look in the US anyway at different facilities and their carbon intensity. So we needed all of these conditions, and then maybe we'd get carbon reductions. So what we did was we looked in our sample for companies that seemed to satisfy these criteria. So we looked for companies, and we could only look at US companies to make this filter work because we could go to CompuStat. So we looked for high plant property and equipment relative to assets. We looked at high CO2 emissions, and using those filters, we ended up with about 200 firms that reported revenue intensity. Now, CDP requires that. They used to require employee intensity also, but in the last couple of years, they've become much more flexible about the sort of intensity data that firms report. So of this group of 198 companies, 87, almost half of them, used an internal carbon price for all 4 years that we examined. Here's the sectors that fit our criteria. So these are companies that, these are heavy industrial companies, transportation and whatnot. There are also companies that will make a lot of investments, airlines buying new planes, utilities maybe building plants or updating and so on. So it's a pretty reasonable sample to look for changes in intensity based on carbon price. And what we found was for both employee and revenue intensity metrics, we got significant reductions if a company used internal carbon pricing over a 4-year study period. And the results are robust, even if the company is using other carbon reduction techniques. And CDP requires the reporting or the disclosure of a bunch of these. They include employee engagement, budgeting for reduction, working with government agencies. There's a few others. The results hold too if there's actually a national carbon tax in place. So the internal carbon tax is doing something in addition to that. The results don't hold unless the companies are consistently using internal price for carbon. Now, the results confirm that internal carbon pricing can work if a whole bunch of things are in place. We have high emitting firms that are making investments, and there's some variability in carbon intensities to begin with. But it's not universally effective, as I mentioned here. And so as a panacea or a solution to climate change, it's just not going to be very effective. It will be effective for companies that are making lots of investments and have all those alternatives to move to low carbon investments. Now, there's some real data limitations here. We wanted to show that it was large capital expenditures combined with a carbon price that mattered, but we didn't have the CapEx data for the non-US companies. We also wanted to show that higher carbon prices were associated with greater reductions, but again, we don't have that because so few firms report that. It's a voluntary disclosure on the CDP database. For people who are thinking about doing other work in this area or extending this, our sample period is short, so we might have missed the reductions for investments that took place later in our sample period because they just hadn't been installed and had a chance to affect the emissions of those companies. The other thing that we found was that the CDP data had a lot of irregularities, and so within a firm, we could see big changes from year to year. Fortunately, the raw data was available and we could put together or create the intensity metrics. And so we did our best to correct these, the numbers reported by companies if there were 100% or 1,000% change from one year to the next. But a lot of them we just had to delete. So as the emissions data gets better, I think we'll be able to do a lot more with this kind of a study looking at how companies manage their carbon. Thank you, and I'll post in the chat the link to the actual paper with the that details the regression results and whatnot.
Thank you so much, John, for that really interesting presentation. So our fourth paper will be Gianfranco with Determinants of Internal Carbon Pricing, or Prices, excuse me.
Thank you very much, Brooke. So my paper is
Sorry
actually...
to interrupt. John, if I could just also ask you to turn off your camera. Thank you very much.
Okay. So my paper is actually pretty complementary to John's presentation. So John was looking into the consequences of adopting internal carbon prices. On the contrary, I and Nuno Bento in this paper, we were trying to look into the antecedents, or what are the determinants of internal carbon prices. So in order to frame the discussion, maybe a quick sort of look at what is the meaning of carbon pricing. So policymakers in the world have sort of converged on the idea of putting a price on carbon as a way to reduce or try to reduce emissions from production and plants in the world. The tools that are used in practice are two. There is a possibility of using a carbon tax, or a possibility of creating a cap and trade system. Some countries actually have both. So, for example, in Europe, we have a cap and trade system, but some countries, for example, France, where I am, is also having a carbon tax. So as you can see from this map that is released every year by the World Bank, the coverage is good in terms of carbon pricing mechanisms around the world, but it's definitely not excellent. And there is clearly this big gray area that is the US, which is a pity, with some sort of local exception, for example, California or the state of Washington. But carbon pricing is taking place in the world as a measure to deal with climate and emissions in the atmosphere. Related to this, there is the question of what is the right price for carbon. In this graph, again, from the World Bank, we can see what is the coverage of the carbon pricing mechanism used by countries in the world, and what is the carbon price actually used by those mechanisms. So you can see that the majority of the mechanism in place, or a regime in place, are sort of in the area between $10 and $60 per ton. There are some interesting exceptions in Northern Europe, which are actually much more aggressive. To give you a point of reference, for many years, there was a sort of a good number of economists that was sort of supporting the view that the actually would say the most effective price for carbon would be in the area of $100, $150 per ton. Unfortunately, the most recent study are sort of casting many doubts about this view. And for example, there is this study by Catherine Reicke that is estimating that actually the social cost of carbon should be much higher. So the range that she's offering is between $177 per ton up to $800 per ton. So the midpoint, the most likely scenario, is $400 per ton. So it's much higher than previously thought. I will not spend much time describing what is the sample. It's pretty much consistent with John's paper sample. So Carbon Disclosure Project has collected for some years now the internal carbon prices adopted by companies reporting to Carbon Disclosure Project in the world. Internal carbon prices are typically used to sort of manage the risk associated with the exposure to climate, or as a way to sort of drive decisions about the business model of companies, and importantly, as a tool that is embedded in the decisions about investments. For example, discounted cash flow analysis for some investments. The interesting part is that is the question of what price are actually company using. And what sort of aroused our attention was the fact that there is a huge heterogeneity, there is a huge variability in terms of level of internal carbon price used by companies in our sample. To give you an example, in the US, Google Alphabet is using $14 per ton. General Motors is using $45 per ton. Exxon is using $80 per ton. So there is, even in the same country, there is a lot of variability that potentially can be driven by the industry. So this is the idea of our paper. So having a look at what are the determinants of the level of ICP used by companies in the world. And in particular, we try to have a look at the country level elements, at industry level elements, and the firm specific characteristics. The sample, as I mentioned, is from the Carbon Disclosure Project, and I would reiterate what John said before, is a pretty messy sample with some inconsistencies. And since here we are looking at the subsample of companies that not only are reporting they are using an internal carbon price, but they are also disclosing the level of internal carbon price use. So is a way smaller sample than you have seen in the previous paper. In total, we have 470 observations. And again, the big warning is that is a sort of a sample that is a little bit messy. So we are going to try just to give some intuition from the sort of about the evidences that we could extract from this sample. So since the research question is what are the macroeconomic elements that determine the internal carbon price, industry, and firm characteristic, and this slide is showing you what are the variables that we have used as a potential explanation for the adopted internal carbon price. So we will start with a sort of macroeconomic variable that is the GDP per capita. And here the prediction is that the higher the GDP per capita, so the most economically sophisticated the country, the more likely the internal carbon price is going to be high. And second one, the fact that the company is located in a country which has a national carbon price mechanism in place should lead to higher internal carbon prices. Third element, an industry one. So companies that are working in the energy industry should be more exposed to climate risk regulation, and carbon pricing. So they are more likely to have an internal carbon price that is higher. And then we look at firm-specific characteristics such as the size, the profitability of the company, which should lead sort of to better opportunity to make investments to reduce the carbon footprint. And finally, we also have a look at the quality of the corporate governance of the company. And in particular, we have a look at two dimensions: the percentage of board independence and the percentage of female directors on board. From a methodological point of view, we use a standard sort of OLS model where the dependent variable is the level of internal carbon price, and the independent variables are, on the contrary, the ones that I mentioned before. Going to the result, this table is showing sort of different models that we have tested. So in model one, we just had a look at the GDP per capita and the national carbon price as explanations for the internal carbon price, and they turned to be statistically significant and with the predicted sign. Model 2 and 3 have a look at the industry and the firm characteristics, and here again we have a sort of mixed evidences regarding some firm characteristics, but the predicted signs are there. Energy, the fact that the company is an energy company has a strong statistical significance, and so our sort of expectations in terms of sign and significance are somehow fulfilled. And finally, model 4 and 5 are bundling together the country characteristics, the industry characteristics, and the firm characteristics. And we observe that definitely the GDP per capita and the presence of a national carbon price keep their significance in terms of economic significance and statistical significance, as the industry does. And then we still profitability is an important driver, and the quality of the board has an impact in terms of the sort of a chosen level of internal carbon price for the companies in our sample. We had a specific look at the presence of a national carbon price mechanism in the country where the company is headquartered. And we used for this analysis a different sort of empirical strategy. So we did just a rough comparison of the internal carbon prices of companies that are in a country with a national carbon pricing system versus companies that are headquartered in countries without a national carbon pricing system. And we also used to try to be more precise, a propensity score matching to sort of detect the treatment effect. So we came up with a difference that is in the order of $25, $27 per ton. So that's sort of the different level of internal carbon price for companies that are headquartered in countries with a national carbon pricing system versus companies that are headquartered in countries without a national carbon system. Very quickly, what are the conclusions of this study? Just a few points. So integrating a climate consideration in firm capital budgeting is getting a widespread practice globally. There is an apparent heterogeneity for ICP levels used by firms globally. We found support for the determinants at macro regulatory level, industry and firm specific level. And finally, as a final takeaway, in finance, there is pretty much a discussion about the fact that finance can sort of replace government and policies when dealing with the climate change. Well, one of a sort of implicit message of this study is that probably finance and the firm behavior should be led by governmental policies, and in particular by carbon pricing mechanisms. Thank you.
Really terrific. Thank you. The conclusions are very interesting, and hopefully we'll get some questions around that. So again, we'll now enter a few minutes of Q&A in the remaining time. So if any of the participants to the panel have a question, please do type it in the Q&A. So we do have a couple of questions that have come up during the presentation. So Ellen, there's a question for you if you could take the floor. Or all participants or all speakers are welcome to take the floor at the same time, and you could just answer questions that come in. But Ellen, have you noticed any of the big impact organizations like B Corp or any emerging ones taking the approach of the universal ownership, or are all based on ESGs due to the investor focus?
It's a really good question. So I have my own critiques of B Corp, not because it's not a great initiative and so on, but because it can be difficult to enforce legally. So if you see that B Corps are listed on the stock market, they then have a hard time keeping their B Corp status or acting like a B Corp. That said, so there are organizations now just starting to take off in this most recent period called, the shareholder commons and others and so on, that are really taking on this question and are explicitly talking about universal ownership. I also am starting to hear from impact organizations that realize that this is actually a really good selling point for them, but not nearly enough. So great question.
Okay, John, since the question to Julia comes from you, perhaps you could both take the floor and you could ask that one of Julia, perhaps providing a little bit of background in posing the question.
Yeah, Julia, I looked at ESG mutual funds a few years ago, and it seems like they're overweighted on the tech side, which might explain kind of these ESG results since we on and Apple and a few of these other tech companies rise so much. Did you find anything like that as you were going through the sample? Any kind of sort of sector weighting bias?
It's a really good question. I think sector is a very important criteria that we also, of course, control for in all our regressions. And what we also did is we excluded all the energy and all the tech companies for one additional analysis that we included now in our new version of the paper, because we also had the question a lot about the oil price, whether that also had an influence on our result. I don't have on top of my mind whether it's really the tech companies that are in the top quintile, but I'll definitely check that. It's a very good point. Yeah, I think so.
Thank you very much.
Important. Mm-hmm.
Okay, Gianfranco, if you could also take the floor. A question has come in for you. Could you explain the difference between OLS and matching regarding the impact of national carbon price?
Yes, I have sort of mixed the results from two parallel papers that we have. So the paper that was presented today about the determinants was just, the OLS sort of regression. While we have a separate paper that is using these matching that is done naive, just comparing the internal carbon prices in for companies that are headquartered in a country with a national carbon price versus the situation for companies that are headquartered in a sort of a country without an official carbon pricing mechanism. So I am happy to share both papers. So to have a sort of a more complete picture about what we believe are the determinants of the decision of companies about the level of price to adopt for their internal decision making.
Okay, wonderful. Just in the last couple of minutes, we can go a minute over, but would any of the speakers actually like to comment on sort of next steps in your research, or any other additional comments on where you hope to take these projects, applicability or next steps? Perhaps we could start. I see the three on the screen right now, so we'll start with Ellen.
Thanks, Brooke. For me, actually, I mean, I have a whole bunch of research projects, too much to get into here, but I think my main takeaway is for practitioners, actually. I think this is a time in which the concept of universal ownership can really take off, but it's sort of up to large institutional investors in particular to take that on and to make it so. So I would encourage anyone who does think that that's a compelling way of understanding global investment to take it forward in every forum they can. I mean, that's part of the reason that I try to do lots of conference presentations and the like, is to kind of popularize this idea. So I hope people do that.
Yeah, thanks. Gianfranco.
Yeah, I would like to sort of reiterate what also John said. This is a pretty messy data. So it's a nightmare for whoever does a sort of empirical work. But we thought it was worth exploring, as John and his colleague have done. So the ideal next step will be sort of get better data with a better coverage. And I'm not sure CDP is really investing further on this sort of topic. So ideally, the ideal next step would be to organize a survey and ask companies or and investors, importantly investors, what they think is the right internal carbon price for their decision making.
Yeah, interesting. John, could you comment perhaps on that as well as your own thoughts?
For our paper, we're going to, we just got the new newest set of CDP data, so we're going to extend the sample period, and I think maybe we'll capture more carbon reductions if they're there. But I think the real insight, and somebody asked about the resources for the future paper that I had mentioned, I think that we need to help people understand when internal carbon pricing can be useful. And a bank that has low reductions and doesn't really make big capital expenditures, it just isn't going to matter. And so I think that we're getting a little bit more mature in finding ways to manage carbon. We had science-based targets, and that was going to be the end all, and internal carbon pricing, that was going to solve the problem. But really, we've got to put everything on the table and figure out what works for what types of firms. And so I think I want to push that idea a lot further so that we have a practical prescription for companies about what in their particular situation is likely to help them the most, and in turn then help society and the environment the most. So I'm hoping that we can get a little bit of a prescription and provide a little bit of guidance about the tools that work in certain circumstances. I wanted to comment too, I thought Jim Franco's result about board diversity was just really remarkable. We're looking at corporate governance. That's where I've done most of my research. And I think that company structure might be where things begin. And I sure hope he pursues that.
Yeah, thanks for that. Julia.
Yes, with regards to the status of our project or where we would like to go, we just uploaded a very sort of new version of the paper because we realized that we don't really make the contribution of our paper, which is this uncertainty component, very clear, and we hope that the new version makes it a bit clearer, because we think that it's a really important contribution to do a more detailed analysis of what those ESG ratings actually capture. So it's not only linked to what happened in the crisis, but much more to what those ESG ratings can actually tell us. And I think there's just much more research that needs to be done for us to understand more in detail what we can actually learn from those ESG ratings.
Yeah. And we've had one final question come in. Aisha Omar, would any of the speakers comment on the preferences of the investors on emerging markets? I don't know if anyone has any thoughts, or maybe Aisha, if you could clarify the question if it's more specifically that.
Only say that if you, sorry to keep coming back to universal ownership, but if you are a universal owner, then you want not just within country inequality and climate change issues to shrink. You would want that to be a global thing, and you would worry particularly about inequality within and among countries as well. So you would want to pay particular attention to developing markets and the extent to which they're also developing things like public pension funds and so on, so that they can actually participate as universal owners themselves.
Yeah. Okay. So we've run a few minutes over and have no further questions coming in. So I think we can thank all of you very much. These have been incredibly interesting presentations. The papers, I'm sure I have seen you've shared some of your links, but I encourage everyone to read them. They're terrific. And yeah, we look forward to seeing further work coming from all of you on these topics. So thanks again for joining us, you and all the participants, and for the excellent questions and discussion today. So enjoy the rest of the conference.